High inflation and tensions from the Russia-Ukraine conflict are among the top risks facing Singapore's economy. That's according to private sector economists polled in the central bank's latest quarterly survey. Economists have kept this year's growth forecast unchanged at 4%. It's also in line with the government's latest forecast of between 3 and 5%. However, projections for inflation were raised because of higher food and energy prices.
The domestic inflationary pressure is also building up because of the recovery from the pandemic. The labor market is getting tighter, wages are rising, and by and large, the overall business cost has increased. So that will eventually be passed on to consumer, and henceforth resulting in higher inflation overall.
Still, inflation is expected to ease next year. The economists surveyed have signaled that Singapore's gross domestic product could come in at 3% next year. For now, the reopening of borders are among bright spots for growth in the months ahead. But how the Russia-Ukraine conflict will play out is still an uncertainty, which could hurt Singapore's trade-reliant economy.
A European recession, which looks more likely because it depends heavily on Russia for its energy imports. Europe does account for quite a substantial percent of Singapore's total exports, and hence a recession in Europe will likely weigh on on Singapore's overall external demand.